right, we want to take a quick look now at a bright spot in the U.S. economy, car sales, right after this. It's getting easier to borrow money if you want to buy a car. SmartMoney.com writer AnnaMaria Andriotis joins us now with the details. AnnaMaria, welcome.
How are you?
People were surprised to see the strength of car sales figures lately. As you point out, one reason why this may be a bright spot, it's easier to get a loan.
That's a big reason. What we're seeing is that more and more lenders are giving car loans to borrowers who they really wouldn't have looked at even a year ago. For example, borrowers, people called deep subprime borrowers.
Well, let me just stop you there for a minute, because what's amazing about this, we are
good.
talking about subprime borrowers.
Yes.
Now, yes, this is for cars, but is there a little bit of, well, why don't you tell us first what's going on, and then I'll worry about it.
So, deep subprime borrowers are people with credit scores that are below 550. That is very low, and lending to them increased 17% over the past year.
Is that just because it was coming from an extremely low level, or is this a sign that things are getting frothy?
It's a bit of both. It's coming from a very low level, but it's also showing that lenders are more willing to look at these borrowers and to work with them. Let's go up one more category. People ranging between, with scores between 550 and 619, that's still considered the subprime. Mm-hmm. They account for 40% of car loan lending right now.
That was as of the third quarter, right?
Yes, this is all as of the third quarter 2011 data from Experian. So we're seeing that lenders are more willing to work with these borrowers, and most of these lenders are banks. These are not,
it's
the
not
smaller institutions. No,
specialty
these are
finance
the
companies.
big banks.
Well, and those same banks actually have talked about asset-backed securities, including auto sales, as a bright spot, an area where they're seeing a lot of activity. And again, it may be almost a supply-side phenomenon. They can make these loans and sell them off. There's demand for them in a way, for example, there's not for mortgage loans. So when there's a shortage of other products to sell, auto loans being one of them.
And they also consider these loans as well to be less risky for a few other reasons. Essentially what they're doing is they're saying that they're starting out with loosening credit criteria on loans that they consider to be less risky. For example, car loans are smaller in size, obviously, than a mortgage, right? We obviously know mortgage lending criteria is still very tight and will probably remain that way for a while.
Well, and there are people who will walk away from their home but keep driving a car.
That's true. So then there's also some other data that the banks say they're looking at, which is delinquencies, the number of people who have stopped paying their car loans, who are literally just walking away from that loan completely. Those numbers are down, proving what you're saying, that there's fewer people who are kind of just willing to sort of get up and walk away from their car.
And David, nevertheless, are we creating tomorrow's problem?
Well, a 17% rise on these kinds of... Look, if investors are coming back to this market, given what we've gone through, I think that's a sign that people are willing to take on risk. And again, in the markets, people are chasing yield right now. So these when you package all these loans, you're going to get a nice return now. And if the credit cycle is really turning at this point, it's probably a good bet for an investor. So down the road, though, the next credit cycle, when it turns, and these things seem to be turning much quicker these days, it could be a problem. But
that's the difficult nature, I guess, of investing in any of these.
You got to time it.
They're also changing the terms of these loans increasingly. What they're doing is they're making car loans last an even longer period. So let's say somebody who can't afford a monthly payment on a car loan that's 4 years. That's typically what people say. You shouldn't really go on. You get a car loan that's longer than 4 years. In fact, that's being extended to about double the time right now.
You mean people are making loans for longer periods?
8 years, potentially more, and
I don't know how I
at
feel
least
about
on the
this.
consumer, and that's not really a good thing, because you're essentially having a loan on a product with a depreciating value.
Well, it's almost a mortgage. I mean, at some point, 8 years when you're talking, in Canada, in some places, it's normal to make mortgage loans for periods of 15 years, and people carry them for much shorter times.
Yeah, but the one thing about a car is that you don't have to go through a foreclosure process on a car that can take you years. And I mean, you can go repossess a car, you sell it, you know the depreciated value, you know what you're going to get. So for a bank's perspective, it's a little more nimble example of a loan to make than, say,
Well, there
a
is
big
a shortage of
housing
used
loan.
cars on the market, so maybe they're just looking ahead to fill that. AnnaMaria Andriotis, smartmoney.com. Interesting stuff to think about. Thank you very much.